Hello, thanks for joining us today for Cutting Through the Noise, the Signature FD weekly investment briefing. I'm Tony Welch, Chief Investment Officer here at Signature FD. So we really ended last week's audio cast on a note about Fed Chair Jay Powell, and he had a speech at Jackson Hole. And we noted that we would probably have something to say regarding that speech. So definitely true to that. We do have some things to comb through on the speech, but starting with market action from last week. Markets generally cheered what Powell had to say. Friday was a strong day. In general, the market was up last week. Large cap stocks were up about 1.5%. We saw strength from small cap stocks, from most individual countries around the world. Bonds had a decent week, and even some commodities were up while some were down, notably gasoline and crude oil had negative weeks. What we saw last week, we would characterize as a broad breadth improvement. We saw 10 of 11 sectors higher by at least 1%, and most stocks joined in the rally. And again, most of these global markets also joined in the rally. And when we see that, that's the type of trend evidence that you tend to see in an ongoing cyclical bull market, not necessarily the type of thing that you see at a major bull market peak. So that was encouraging last week. So let's move on to some of the macro data that we got that was driving these trends. So from a negative perspective, there was a big revision to the jobs data. The BLS went back. They looked at jobs data from April of last year through March of this year. So this is really quite lagging, but they did revise the jobs data lower by over 800,000 jobs. It really translates to 68,000 jobs per month in the 12 months through March. And what that kind of looks like is a rate of job creation that's lesser than what was reported, but still job creation nonetheless. Now, that data did come and corroborate a lot of other data that we've been seeing, such as the new hires rate, which has been falling, the quits rate, which has been falling, and wage inflation has been softening as well. So that big revision made sense when you look at it in the broad picture with other employment data that we get. Now, our friends at Ned Davis Research, they like to do a recession probability indicator that uses state level employment data. And after these revisions came through, they basically were saying that there was a near 0% probability that the economy was currently in recession. When you look at all these revisions together, that did uptick slightly up to a little under 12% that the economy is in a recession or will be in the very near term. Still not the type of recessionary odds that we would place in high recession risk camp, but it does start to make sense that in Jay Powell's speech on Friday, he started to pivot more towards the economy itself and the labor market. Clearly, the economy is slowing from a very fast rate of expansion. And Powell alluded to the softening in the labor market and that they didn't want to see further softening from here. They also have gained confidence that inflation is under control. And a lot of that is because of the softening wage inflation that we have seen. So we do think that the cutting cycle is likely to start in September. Now, on a positive note, last week we did get some signs of life from the housing market on lower interest rates. New home sales actually crushed the consensus of a 628,000 unit annual rate. That's what economists had expected. Instead, we saw new home sales rise at a 739,000 annual rate. So rates have already come down a lot in expectation of this future Fed cutting cycle, but it was good to see that the economy started to respond to lower rates, in this case, lower mortgage rates. Now, we have seen a lot of charts coming out. If one were wanting to be bearish on the economy and the markets, you would point out that a Fed cutting cycle was actually begun in 2001 and in 2007 before some major bear markets. But we would put this down as completely a case of of mistaking correlation and causation. For us, what we've noted and the indicators that we follow is that is unequivocally a bullish macro event to have interest rates falling. Now, there have been some rate cutting cycles where the Fed has had to cut deeply because we've been in an economic recession. But it's also true that in most cases that they've embarked on a rate cutting cycle, they've been able to do it methodically and slowly. And those cases have actually seen very positive market outcomes during the rate cutting cycle. Now, as for this week and what we're looking at, here Monday, we got durable goods orders, and those came in at 9.9%. That's a very strong number for durable goods orders. That looks like it was really led by a bounce back in transportation orders. For the rest of the week, we're going to have some housing data and consumer confidence data, but likely the most important report that we're going to get on the week is going to come in the form of the personal income and outlays report on Friday. And in that report is PCE price inflation. So that's the inflation number that the Fed really likes to pay the most attention to. So we'll look at what that has to say. We don't expect that it's going to derail the September rate cut. So join us next time as we kind of sift through the data that we get this week, the inflation data, consumer confidence, and some more housing data. And as always, thank you for joining us and have a terrific week ahead.